excited to partner with FEI to host this event. It's great to see such a big crowd. They said to Bob this morning there's probably 3 topics that would get a crowd like this: tax reform, blockchain, which you have covered, and cannabis. So that's a future one. I guess get on the schedule. You know, it's funny, we were supposed to hold this back in March. We had a bit of a snow delay. I think between the snow delay and now is probably about as long as it took Congress to actually pass the tax laws. So, interesting. You know, a little bit about our firm. We're a full-service public accounting firm, you know, providing all audit, tax, obviously, advisory, consulting services to our clients. Our clients range from small mom-and-pop startups to large middle-market companies. We also handle high-net-worth individuals. They're you know, not only their personal work, their businesses as well. We have a very good panel here. We have one of our panelists is caught in Connecticut to Long Island traffic, which we've both been there. She should be here shortly. But without any further ado, I want to turn it over to our tax practice leader for our firm, a Long Islander at heart, and our moderator for this morning, Joe Woodward. Joe?
Thanks, Mike, and thanks, Bob. It's good to be here. I'm not a New York City resident yet, so I can still say I'm a Long Island resident. A couple of things. You know, you mentioned about cannabis and blockchain. We actually in our firm have 2 emerging groups. One in cannabis. We do a lot of work in that space. We also do a lot of work with blockchain, Bitcoin, initial coin offerings, a lot of clients. So that is a very interesting session that they should definitely attend. I know you save a lot of people money for these meetings, which is great. Today, you know, we're going to have some good news. We're going to have some bad news because this tax law did cost people a lot of money in certain areas, and the corporations, as you'll see, actually did quite well. But as Mike said, my name is Joe Blay. I'm a tax partner and the firm's tax practice leader. We have a great panel today. We have Don Rue, who will be talking about corporate and accounting for income taxes. Eric Torres will be talking about individuals. Andy Tarquinio will be talking about business changes as well as the pass-through entities, the QBI, which I'm sure you've heard a lot about. And then we have Jen Sklar-Romano, who will be talking about the international tax provisions. And what we'd like to do is to make this presentation as interactive as possible. So while we're going through the material, please feel free to ask questions, raise your hand, we'll answer them on the spot. In addition, we anticipate having some time left at the end for a Q&A. And lastly, when the presentation is over, there'll be time for some one-on-one discussions as well. So we have all that for you. Now, before we get into the presentation, one of the things you should realize is that the Senate had a budget constraint of $1.5 trillion revenue loss over 10 years. That was the projection they were working with. The House didn't have those constraints. So when the bill was scored by the Congressional Budget Office, it had to come in at $1.5 trillion or less of the revenue loss. And that's why when you sit here and listen to all the phase-in and phase-outs and odd dollar amounts and why something applies up to this point stops, and why the individual provisions, for the most part, sunset after 8 years. They go away, back to the old law for the last 2 years. It was all so that it could fit within those budget constraints. In addition, when the House bill first was produced or proposed, they had a reduction in the corporate tax rate from 35% to 20%, ended up becoming 21%. That estimate of the revenue loss alone from going from 35 to 20% over 10 years cost approximately $1.5 trillion. So one item alone used the entire budget deficit capability that the Senate had. So all the other provisions were a zero-sum game. Some people won, some people lost as you go through. So that's just something to keep in mind. That everything else had a net to zero, otherwise they couldn't pass the law. And we did a fair amount of work with some industry groups in trying to get provisions changed or repealed, and it was really a two-process step that wasn't only the merits of your provision, you know, why should we do this or take this out or change this, it's, well, how are we going to pay for it? because I said it's a zero-sum game. And it's also interesting that I think there are about 11 to 13 Republican representatives from the state of California. And they all voted for the House bill, which has the sole repeal, which Eric will go through. And I know there were a couple representatives here from Long Island that voted against it. So the Republicans from California voted for the repeal, and then as it moved through the Senate and then went to conference committee, they finally realized, well, maybe we should try and take a stand and do something to cut back the loss of the state and local deduction. But by that time, it was far too late. They should have done something early on to at least scale back in a meaningful fashion the loss of that state and local tax deduction. So they had a missed opportunity. And we'll go through that a little bit more. Okay, so we'll start with the individual section. I will talk a little bit about the tax rate changes, and I'll turn it over to Eric. And one of the questions we get all the time is, what will the average taxpayer save or pay under the bill? Well, the fact of the matter is there is no such thing as an average taxpayer. Every taxpayer has their own different information, permutations and combinations, so it's very hard to make a general statement. But we have some examples that we'll walk you through. But the first thing is this here is the tax rates. You see that currently the maximum tax rate is 39.6, reduced to 37%. But what's interesting here is when we start to look at this, the rates and who it affects, is that it used to be a long time ago, back in the day, that joint filers' tax brackets were double the tax brackets that you'd find for a single taxpayer. And then over the course of time, they put what's called the so-called marriage penalty in the law. So where the marriage tax brackets were not double the single. Well, this law, when they first came out, removed the marriage penalty. And you'll see the tax brackets for the single versus married filing joint return is double until you get to the end, which we'll cover that in a second. But the effect of doing that is that for individuals that are filing as single taxpayers are going to get into a higher bracket under the new law quicker than they did under the old law. So if you look at the 33% bracket, single person was in that bracket at 191 under current law. Now it's 157. So at a lower level of income, you're in a higher bracket. It's 32 versus 33, but still you're in a higher bracket. Here, at the 35% bracket, a single taxpayer got into the 35% bracket at $416,000 of income. Now it's $200,000. So I think, and we haven't seen much written about that. So the single folks, when they start putting pencil to paper, I think will be somewhat surprised. And then on the top end, for married folks, filing joint return at 470 is where they hit into the maximum bracket under current law. Under the new law, it's $600,000. So there's a little more runway before you get into the higher bracket. Now, both the original House bill, even the original Senate bill, had the maximum bracket for married taxpayers starting at $1 million, which is double where you are for single. But again, they're looking for that revenue. And at the last minute, with all the horse trading going back and forth, married taxpayers filing joint returns had it knocked down from $1 million to $600,000, just like that, both. So you're in the maximum bracket at 600 as opposed to $1 million. So that's just some interesting things on the brackets. Now, turning to some numbers. So we had somebody in the office ran numbers at different income levels. Now, in this model, the $10,000 of dividends, the $40,000 of real estate, and 2 children is constant throughout. So the only thing that changes here is the income level, and we'll assume that's a W-2 wages, plus those other items. And you see the federal tax decrease and increase. So there's a $19,000 savings at $400,000, drops to $18,000, $4,000, $5,000. You see it through the course of time. Okay? So that's depending where the income level is. But again, the problem with this, and look, the devil is always in the details. You can put any set of assumptions together to prove your point, and we have another set which we'll show you. So you see that there's a savings throughout here, which was kind of surprising, frankly, when I saw this. Then we changed it, and we just made that person a New York City resident. So the income is the same, the W-2 is the same, the deductions are the same. The only other deduction they would have, of course, would be the deduction for New York City income taxes, which of course went away. So you see how the numbers change, that there's a savings at $400,000 and $500,000, but when you're over $500,000, it's actually a tax increase. And the differential between those two is, of course, the loss of the New York City income tax deduction. And of course, in addition, of course, the loss of New York State income taxes and the real estate taxes, and that's what is the change there. Okay. Then we looked at it another way. And here we said we have different income levels, and as the income level increases across the board, we've also increased the dividends. You know, as people earn more, they've saved more, the dividends increase, their capital gains are more, maybe they live in a larger house, so they move, so their real estate taxes increase, miscellaneous itemized deductions, investment expenses increase. So it's not the same static $10,000 no matter what your W-2 income is. This, I think, is a little bit more realistic. And what we did here was we ran it at a New York State resident, joint filing return, New York City, single, just in New York State, and a single person in New York City. Again, with the same income levels throughout each of the cases. And you'll see here, and we don't have to go through it too much detail, but as you'll see is that the people in here, let's talk about the New York State, they're pretty much the same through here, these first three levels. Cases 2, 3, and 4, they're pretty much the same, state and city. And this is because the folks in this level here are probably in the AMT, right, the alternative minimum tax. Okay, basically for alternative minimum tax, separate tax calculation, you don't get to deduct the real estate taxes, the state income taxes, you don't get to deduct your miscellaneous itemized deductions. So from this level, whether you're in the state or the city, it's the same because you weren't deducting them to begin with. And then as you move out and people are out of the AMT at the higher income levels, you were worse off if you were a city resident because, again, the loss of the city tax deduction. On the single level, it's the same thing for the first couple levels. You're pretty much the same, but you're not, your savings or your increase is worse off than if you're filing joint, as we discussed with the tax rate brackets. So you can see from this is that, again, every taxpayer is different. You really have to run your own numbers, and I know what we're doing for a lot of clients is when we're running the 2017 returns, prepared for 2017 returns, we're doing quick projections. We can either run them in our software or separate software to see how they'll come out under the tax law. So it's just very interesting. And some surprises, okay? And then, now I'm going to turn it over to Eric, tax director here in this office, and he's going to go through the things that are gone, coming and going, and you'll see, depending upon which items you have in your return, will dictate how well you feel under the law. Because for some taxpayers that do not have a lot of the items that are going away, they would tend to be better off because the things that are going away they never had to begin with. So the loss obviously doesn't affect them. Okay, so Eric, over to you.
All right, thank you, Joe. So when we put these slides together, as you can see, there's not a lot of meat to them. So I decided to take it from a entrepreneurship, trying to give you, where we go just outside of tax, give you some advice. So something's going away, how to consider. Things that are gone, personal exemptions, and they went to offset that by increasing the standard deduction. Outside of being Octomom and having 8 exemptions, most people are not going to be that affected by personal exemption. So you do need to consider it, though, for anybody who's claiming head of household. You still have to consider the fact that you need to have at least a dependent to claim yourself as head of household. That's to consider there. Under the miscellaneous itemized deductions of Schedule A, tax prep fees, accounting fees, we obviously want to focus on that because we will be able to, us as accountants, we want our fees to be deductible in some way, shape, or form. Unfortunately, that goes away. Take into consideration to see if it's possible, if you have a self-employed business, if you have another business that's generating business type income, you may be able to take those expenses against that business activity. So then not necessarily Schedule A, but look to Schedule C. Employee business expenses, this is where having that relationship with your accountant is significantly, even more emphasized how important it is. Take a look to see if you are an employee versus an independent contractor. As an independent contractor, you can look to take a Schedule C deduction for these items. If you're an employee, unreimbursed expenses starting in 2018 won't be deductible. Entertainment expenses, not meals. So when this first started, entertainment expenses used to be subject to a 20% haircut, then a 30% haircut, and up until 2017, it was a 50% haircut. Now for entertainment expenses, we're talking about taking a client out, going to sporting events. That's where we thought this was going to stop. They've actually now modified it to include meals that you provide for the benefit of the employer to their employees. Those used to be 100% deductible, now they're 50% deductible. Situations where you would pay for going to charity events, those are now, used to be 100% deductible, those have also been cut down to 50% deductible as well. So it's even more important to, when you're reporting to your accountant what your meals and entertainment expenses are, that you actually take a thorough analysis of what's in there. These are permanent adjustments, so if you do a haircut, it's not like you'll get a deduction in the future year. Once the deduction's taken off, you no longer get a benefit for it. The shared responsibility payments, that relates to not having insurance. It goes back to the whole mandate. That takes place in 2019. For those of us, I can't, thankfully I'm still married, for those of us who have to deal with alimony, after this busy season, I thought my wife would have divorced me, but she's stuck around. No longer are we going to be in a situation where the alimony has to be picked up into income and the other partner is picking up that deduction as an above the line item. Okay, gambling expenses in excess of net winnings. This was not something that we're too familiar with, so I looked into it before. Historically, gambling losses were limited to gambling winnings.